Talk Viewpoint. I'm Chantel Leeson, your host. We are the online talk show, and also we're actually a virtual, I'm going to say we're like a virtual resource library for financial investors, for high net worth, ultra high net worth, family office, and family-owned businesses. And I consider it a resource library because many people, when they are looking for ideas to invest their money, particularly family-owned businesses and high net worth investors, they want to get a little information first. And sometimes they want more than what they're being told by their local advisor. They want to have an objective way of looking at things. Anyway, I interview people all around the world and around the country. And today I have a special guest. He was here. He's from a return visit from a couple of weeks back. This is Dr. Victor Chukwuemeka, and he's an economist from the United Kingdom. And I'm going to turn it over to him. And we talked a lot about a lot of things. How are you, by the way?
Very well, thank you. Thanks for the introduction. Very well, thank you.
We talked about a number of things in our last visit. We talked about the economy, the divestiture from the United Kingdom from the euro. We
yes, indeed.
Conditions around where you are and also where I am. I know we're in euphoria here because we're looking at our election upcoming, and you just had yours.
We have indeed, yes. Very interesting.
So I'm going to turn it over to you. Tell us about that. You do a lot on research for the economics on research on real estate, and not just in the United Kingdom, but around the world. I'm going to let you just take the stage here and tell us about what you do and how you're able to help people.
Yes, well, I run a company called Affluent Asset Analytics. As you say, we help family offices, high net worth individuals, etc., to invest their funds in real estate, be they physical properties or on the stock exchanges. And these are mainly in 4 different parts. The majority of them are resale outlets, offices, and industrial warehouses. We do a few hotels as well. So what we do is to forecast growth. I've been in this business for quite some time now. So we forecast growth through rental growth and income yields. And we determine what the long-term, medium-term, and short-term forecast will be for our investors. So they have diverse portfolios and assets, and they want to know where they're going to invest their funds. And I produce this research for them. And not only that, but I make sure that I fully explain why I think, for example, Lithuanian warehouses might be a good investment vis-a-vis, I don't know, Slovakian hotels, for example, so that it helps them diversify their portfolios and get the best out of their funding. And that's generally what I do. So part of that work also is looking at the green aspect of real estate funding, because that's now become a major thing now. People want to invest in green buildings around the world, and that's becoming very, very big now. And I do concentrate a lot of my efforts on the green aspects of that, because if we're going to reach net zero, as you know, in this country by 2050, we're going to have everything, whether it's car emissions, whether it's housing, whatever it is. Everybody has to pull together towards that end. And those actual assets at the moment are proving to be quite valuable, and people are wanting to know about those kind of things. So I go around the world looking to see where the growth areas are in those kind of real estate markets, and provide that kind of information to the investors, and they're quite happy to get that kind of information. The other bits of my work also is looking at economic shocks. Now, economic shocks are one of my, I would say, my main forte as far as economics is concerned, but I have transferred this into real estate. What people want to know is, when there's an economic shock, what's going to happen to their real estate and portfolios, their investments. So if, for example, there's it could be a small economic shock, like a money supply shock, for example. How's that going to affect real estate prices in, I don't know, rental growth rates for retail outlets, for example, in the United States? Let's say the Fed increases rates. What might happen to the retail sector? Is that going to be more valuable? Are people going to be more online or more in the retail outlets? All these things really matter, and people want to know how these shocks are going to affect the real estate market. And my sort of premise for economic shocks was when I was a very, very young boy. I started to look at the euro when the euro was touted as being the in thing in 1999. I did promise myself that I was going to study a PhD and make sure that I explained to people that this wasn't such a good idea, because when economic shocks happen, it's going to make certain countries rigid and others more flexible. And I couldn't see how two different countries were going to align themselves together, having one single currency and one interest rate. So I made that my thing, and I've now transferred this thing into a something that I've also proven, because look at Europe now, it's very much more rigid than it was before the euro. But I've also transferred it into my real estate sort of investment strategies, where I make sure people want to know what's going to happen when an economic shock happens, what's going to happen to their portfolio. And I use something, I won't bore people with it, something called orthogonalized impulse response functions. Forget about that. All you need to know is what will happen to your real estate portfolio if economic shocks happen. And they happen all the time. So it's very valuable information for the clients.
And we call it market correction here.
All right, something good.
You're calling economic shock, you call it market corrections here. What do you think interest rates, now I know interest rates affect everything.
Correct.
Interest rates affect your ability to buy real estate. And I want to look at real estate from a different perspective. For the average person, that interest rate affects whether or not the average person can afford to buy a house.
Correct, yes.
Share a little bit about that for our audience.
Yes, well, if I was to take the United Kingdom, we've obviously had, since COVID since the start of the financial crash, interest rates were at rock bottom, and they were for about 12 years before COVID started.
Yeah.
And then COVID happened and they went even lower. But then obviously we had the war in Ukraine, and we had, the Russian invasion of Ukraine, etc. And that was the main economic shock. Interest rates having to go up because inflation rose. All sort of raw materials, cost of raw materials, etc., increased, and we need to sort of stop people spending. Now, personally, and this is just a personal opinion, and I've got into a lot of arguments with economists and also people, that's a cost problem. It's the cost of a raw material rising. That's not a demand problem. For me, it was not a demand. It wasn't the fact that UK residents were demanding more. It was the fact that inflation was rising, because the costs were the cost of raw materials, i.e. oil, etc., from Russia, having to find it in less supply than it was. So obviously the price went up, and that was putting pressure on our prices, and everything that raw materials I used to make obviously going to go up. I didn't think that when we were in a sort of recessive period that the government, that the Bank of England, in our case, should have put interest rates up. However, they have done that. Inflation has come down, but that, I believe, is because the price of fuel, etc., has come down for other reasons. So I don't really think that was a sort of a reason to put up rates, because people really have suffered. They really have suffered in the UK. Young people, I was just listening on the radio this morning, young people are not able to buy their own house. Even if they have a deposit of £20,000-30,000, they're still unable to afford their housing because interest rates are so high. And if you put interest rates of 5% onto a capital of £380,000 for a first-time home buyer, that's a lot of money. That's a lot of it's a lot of sort of interest to pay on a mortgage, and people just simply can't afford that. So it's a good thing that it looks like we're now at the top end of that, and interest rates look like they are going to be coming down in the sort of near term. Hopefully, we have another round of the Bank of England meeting, and then hopefully they're going to start putting rates down. We've got inflation down to 2%. That's where we want it to be. So hopefully now the rates will start to go down. People will be able to afford more things and do the things they would like to do. And that's where we are.
And that's the bottom line. If you need to have money to be able to spend. And if rates are too high, you're not able to spend. Let's go to another part of the market. We're talking about, I just asked about the individual buying a house. How do these interest rates affect? Two questions. One, where do you think interest rates are going to go? And what's the impact on the affluent investor? Because see, they're the ones that invest in properties that are mega-sized structures, multi-unit housing, office buildings, and so forth. How does that affect? What's the effect going to be on them in the UK, but also globally?
Well, for the average person, prices, interest rates going down is obviously it's a great thing, because then they'll be able to spend more, be able to afford more. I think the UK problem is more the fact of a housing problem, with a massive housing shortage, and that's why the prices are so high and rents are so high, etc. If interest rates going down, it's kind of it's obviously a good thing for investors, affluent investors. It's good because they can obviously the markets will sort of pick up on that. Interest rates going down is obviously a good thing for everyone. Nobody wants high interest rates. We want to be able to invest more. High interest rates is not investable for sort of FDI people coming into this country, etc. Lower interest rates, it's much better story for everyone, particularly, especially with the average person and more so the affluent investor.
Right. And I think when it comes to the high net worth that buys multi-unit property, even though they're able to maneuver whatever because they have a lot of money at their disposal to buy and sell properties, it still is important to have the right interest rate to buy, the best rate to buy at the lowest rate.
Yes, sure. Yes. It's very important that. I think that's a very important point. Yeah, very, very much so. Obviously, the lower the rates, the more sort of flexible people are, etc. And money changes hands a little bit more easily and more sensibly as well. So I think it's a very good thing, definitely.
How are you able to help as an economist? How are you able to help people that are investors that I know they look for you all over the place. Name your company is
Affluent Asset Analytics.
Right.
Yeah.
Now, tell investors how you're able to help them.
Yeah, so they have a wide range of portfolios from the stock markets, whatever they put their funds in. And the way I'm able to help them is to look at the sort of, let's say, offices in Norway, for example. So I take them 3 different streams: offices, retail outlets, and industrial warehouses. Those are the 3 main areas, and some hotels. And I do a sort of a forecast of 1 year, 5 year, and 10-year forecast. And I look at income yields and I look at rental growth to see how these in specific cities and sometimes even locally, how the forecasts are going to look like over that period of time. And obviously, people look for the highest yields, look for the highest rental growth areas. Obviously, put funds in there. Rent rises are going to be much more investable than possibly an area where rents are not rising so much. So I look at rental growth areas and income yields. So people who put their income in a particular into a particular domain, if they're going to get higher yields, then they're also going to put their funds into that. And I do a whole lot of calculations. It's quite complex stuff. But what I get at is an income yield of, I don't know, it could be 10% of right now. So Slovakian warehouses, that's an investable sort of stock market a vehicle, if you like. So people are able to diversify their portfolios on the basis of the forecasts that I give them. And that's how they're able to use that.
That's very important. Because when you're talking about portfolio, you're talking refers to the individual's assets or bundled assets like funds, like real estate investment trusts or mutual funds.
Yes, there's things like REITs. They could be exchange traded funds. Those sort of investment vehicles that they are able to put their funds in and get the best out of their investment, definitely. But there are other people who are, say, for example, international developers who sort of come to me and say, look, I'm thinking of the new markets, the emerging markets. That's the other area I look at. And they say to me, so where are the emerging markets? And could you also let me know about emerging markets where they're possibly green, more sort of the greener sort of areas? And I might say, I don't know, this is just off the cuff. But Mexican offices are looking quite nice in this particular city of Guadalajara or whatever. These offices are sort of yielding 9.5% at the moment. They're green, they're very good, they're sort of investable. For the next sort of 10, 15 years, they look very good. That's the sort of thing I'm looking for. That's the sort of thing I'm looking for. And I would give them a sort of a whole project of why I think this might be the case, rather than just telling them that this is what it is. But there are a lot of sort of many different things that you put into sort of an economic scenario to build a story of this making. It could be the fact that regeneration or urbanization or people sort of migrating or moving out of an area. There could be many different factors that are contributing to this. But at the end of the day, my work is to get the data, crunch the numbers, and produce a result for them. And that's generally what they look for.
I know you work for Barclays. You've worked for Barclays, and you've worked for Lehman Brothers in the past, right?
I did, yes, correct. As an investment banker, yes.
Competitive environments too.
Yes, very different environments. One is still going, one is not.
Well, that's right, and that happens. That's what the economic crisis did.
It did. Yes.
Investment firms.
I remember that day. I wasn't at Lehman at the time. I was actually working for Commerzbank at the time. And it was a shock to everybody. It's obviously it's not a nice thing to see that kind of thing happening. It was a year of people sort of getting their acts together and thinking what's going to be. Nobody really knew what the world was going to look like after that. A lot of the banks were saved. I think a lot of the American banks were saved. Lehman, unfortunately, was one of them that wasn't. But in this country, we had many of them. Many of them were saved, and taxpayers' money was sort of put in to bail them out. And obviously, the governments needed to do that around the world, and they did that. But it was, yes, a very scary time.
No, I remember it very well. Yeah,
Yeah.
I remember sitting at my desk and watching my clients' portfolios sink and having to tell them that this is not the time to jump out, because that's when people want to flee the scene. And the problem is when they flee like that, then they never recover.
Correct. Yes.
Right, unless you really are a very strategic or tactical, unless you do a lot of tactical investing, which is more involved in more option trading or that type of trading. But you're buying long-term securities, that's not a smart move to jump out of something like that. It recovers and recovers very nicely. It's just that if you get out too soon, you don't have an opportunity to make the upside when it does recover.
Exactly, and it's knowing when to come out as well. Obviously, you know, if you have long-term securities, then you know it's obviously more sensible to wait for those because it will correct itself, and that naturally does. But yes, don't come out too soon. And that's basically general advice. It was a very, very difficult time for everyone. But you know, unfortunately, from that, the way I look at the European problem with the euro and the countries aligning themselves together, I don't think they've ever really recovered for that. And that's one of the things that I studied many years ago. I said I was going to make do a study to prove that. And as you can see, Europe just hasn't grown as much as well as it would have, and the UK as well, since that time. That economic shock, it would have been a temporary shock, but now it unfortunately looks like a permanent shock. And unfortunately, the United Kingdom hasn't grown anywhere near as much as it would have had since 2008, and that's been a big problem. It has hurt our investments. You know, Brexit obviously wasn't the best thing that happened for investments, because people in 2016 just did not know what was going to happen to the UK economy. And obviously then we had COVID. That was a problem for everybody. But these economic shocks have rendered the European countries quite rigid, as opposed to being flexible enough to move themselves out of that state and back into their, let's call it, equilibrium state, because they are aligned together and they just simply cannot move properly. And that's one of the problems from the financial crisis. That shock has now become, unfortunately, a permanent shock.
Well,
And that's just my opinion.
is that right? You feel it's a permanent shock?
I do think that it definitely is a permanent shock. I mean, people say, yeah, you know, when you put the euros aligned together, the euro will be strong. Well, that doesn't matter. If the euro is strong, it doesn't necessarily mean that the countries are going to work very well together. It's been proven that prior to the EMU and the formation of the 11 countries,
Yeah.
they were adjusting much better in terms of certain parameters were adjusting much better than afterwards. It was much more expensive to adjust than before. So it's obviously much more expensive for European countries to adjust after the euro than before the euro, and that's a problem. If it's more expensive to adjust, it's much better to have your own currency and interest rates to be able to adjust, as opposed to sharing a currency and interest rates and adjusting them, because then other factors such as employment, or let's call it unemployment. If there's unemployment, that's a welfare cost, and welfare costs are obviously detrimental to countries. And this is a major problem for the European countries in that sense. And so that's why, for me, the EMU was I think it was one of the big disasters of Europe, and it's rendered a lot of countries. The UK does 44% of our trade with Europe. It's a big problem. We can't do trade with Europe if they are not sort of demanding as much as they would have done prior to the EMU. It's not good for us, and this is going to hurt. This is going to hurt investments coming into the country, because they're not seeing us trade as much as we would like to, and that's been a big problem, I think.
I mean, there's not going to be any easy changeover back to what it used to be.
No, and I am in discussion also with the European Commission, sort of writing letters as to their 2025 convergence. It's coming up soon. All their convergence criteria have to be met. They want to see where they are. How has it gone? They're going to sort of do a full report, and they have sort of assured me they write letters back to me. I don't actually. It's very strange. They actually were going to write back to me. They've written back to me and say, you know, everything is on course. We are actually have noted down your concerns about Europe, etc. But we are aligned to sort of meeting our goals and targets, etc., and all that stuff thing. But I'm still not swayed by that, to be honest. I really do think that I'm not sure where Europe's going after 2025. We've got all sorts of other problems around the world. And I think one of the big things was this amalgamation of currencies and interest rates. For me, it just doesn't work.
Okay, you know what? Let me ask you this, because I'm sure that listening to this, there are people that want to look forward and want to look at what would be the best strategies. What are some suggestions, or what would you position in helping someone to think forward? Because looking back, yes, we know it happened. You can't change the past. It's how we react going forward.
In terms of personnel, people, or in terms of governments?
Well, let's look at both sides. Let's start with people first.
Yes, I mean, well, people can't really do much about it, really. There's nothing you can really do. I think in terms of
they're going to invest regardless. They're going to invest. They have to invest money that they prepare for their futures, for their retirement, for their families. So they're going to invest their dollars.
Yes,
and
I think in terms of,
go ahead.
Yeah, no. In terms of investments, obviously, people really need to look for the future. Obviously, not as you say, not to look back. I think people obviously have to be very sensible with funding, with their funds. Property is obviously a very good investable sort of vehicle to go into. If people are looking, and anybody can invest in stocks and real estate, etc. REITs are obviously a very, very good investment vehicle. Come to me. I will show you where the investable areas are. So obviously, I'm not going to go now into details of which places are investable, etc. What I would say is people can look at things like look at the retail space. The shopping centres are now, particularly in the United Kingdom, they're disappearing. People are now going more online. So people are now looking into industrial warehouses. Industrial warehouses, particularly in areas like Eastern Europe, are much more of an attractive vehicle than, for example, office spaces which are closing down, not closing down, but people are much more sort of hybrid, working from home, that type of thing. So those kind of things that people can look at and invest, if they're looking to invest their funds in those kinds of areas, without giving too much away, obviously. But that's just a very sort of generic picture of what's happening at the moment. And likewise, I guess, for investors, affluent investors, very much the same story. As far as governments are concerned, that's a different matter. Yeah. If we're looking at the United Kingdom, if I can just sort of go to the United Kingdom, obviously we've now had a change of government, and they're looking to build an economy. Now, if you're going to build an economy, that's great. Everybody wants a strong economy, but how are you going to do that? You know, and one of the things that I think you're going to do, you should really be doing, is looking at investment. Foreign investment, direct investment coming into the country is one of the things we have, but we have to make the conditions right for people to be able to invest. We need low interest rates, we need skilled labor, we need all these kind of things. And at the moment, we don't have the skilled labor that we need to be able to move ahead as much as we'd like to. And we've become much more of a sort of service industry as opposed to manufacturing, etc. But it's still an investable country, it's still a country that people should come and invest in, but we need to have lower interest rates, which we're now starting to have. We also need to make sure that all our infrastructure is correct. We have really good rail projects that are happening. Unfortunately, we've shed one or two of them. It's cost lots of money, but you know, we have to have a place where we have the conditions that are right, and foreign direct investment is the best way to go for the country to start to grow again. It means all sorts of things without getting very political about it. The governments are talking about, you know, getting people off of welfare and that type of thing, getting people back into work. Lots of people who are not working. Let's get house building projects happening. People are paying far too high in rents, etc., rather than investing their funds into different things. It's a bit of a problem, and those are the kind of areas they're looking to go, and governments are looking to go into. Talking obviously on the behalf of the United Kingdom, but if we want to, we can obviously talk about Europe, etc., which is my sort of main area. But we won't go into that now.
Let me ask you another question too. How has the war in Ukraine and Russia affected the economy in Europe?
It has been a difficult time for the last 2.5 years now. We've seen with the rising costs. Rising costs are no good. That's inflationary. Inflation is not competitive. we just couldn't sustain that, and it has in fact affected us, particularly in the United Kingdom. We've had to have interest rate increases here, and it's been very detrimental to our to businesses. It's detrimental to people who can't spend more, as they'd like to. With the higher rents, people have got less money in their pockets, and we're having to start sort of cut costs in different places. Governments are having to do that. We have something now called for example, the winter fuel allowance. The sort of 10 million elderly people are now having that cut from this present government because we simply can't afford that. And that's not directly as a result of the war in Ukraine, but the war in Ukraine has exacerbated these kind of things because it's been a very difficult time. But fortunately now, after 2.5 years, we've managed to get our interest rates down, and that's the start of what we hope to be growth.
We're getting toward the wrap up of our half hour here. Give me, what would you like to share with our audience, that something they can take home with them?
In terms of investing, in terms of anything, or whatever
you think. I'm going to leave it up to you to decide what you think.
Right. Okay. I think we've had a very difficult 2 years, 2.5 years. I think it's we're now coming towards the end of it. I think it's now time for sort of governments to start looking to see where they can grow their economies and start to get bigger and stronger. I think they also need to start being a little bit more sensible. But I think one of the things is that people shouldn't despair so much. If governments, particularly in the United Kingdom, say what they do what they say they're going to do, then we should see a very sort of prosperous 4 or 5 years. It's not going to happen immediately. It will happen over the long term. And people are also starting to take net zero seriously. And I think that's a good thing. That's a great thing. And if people are looking at investable vehicles, look towards the green economy. That's the next thing. This is good.
Well, you know what? It takes a number of these to get used to them.
Yes.
What it does is that when I first started, I was all over the place. Now I kind of settled in, and what makes me feel a little more at ease in how I'm talking to an audience and how to get my subject matter out. But I think that you as an economist is important. Let the world know what you do, how to reach you, and some of the ideas you're sharing today. That thing about, to me, is important to understand, because investors need to know what's going forward. We know what's happened in the past. We can't change the past. It was a huge fiasco. I want to leave. In fact, what happened to me in the end, I want to go from my old firm to JP Morgan. So I went. It's like I stepped up, and I stepped up to a vice. It wasn't this. I was a vice president. I wasn't a huge major level. I was a mid-level vice president, middle management vice president, but still a nicer title and a nicer position. And that's what people look for. They want to know, where am I going? What's the future to hold? They look for themselves. They're looking for their children. What can I do now to make an impact on tomorrow?
Of course, and that's a critical thing. People want to know what they should do in the future. Definitely,
right.
Absolutely.
They're still going to take their vacation and go on holiday by the seaside, as you call it. No matter what, we still just have some time to wind down. That's the whole part of having a holiday away from
exactly,
the hustle and bustle.
Looking forward to that tomorrow.
Absolutely. Well, I'm going to be in Europe probably about October or November.
Oh, right. Okay.
Yeah, my daughter moves in. She's home. She's going to be home this week, and she moves to France at the end of the month.
Right.
And we're going to be in France, probably south of France, sometime in November. Yeah, probably November. I shoot through London like I go through all the time, so I will follow up with you while I'm there.
Yes, excellent. Yes, well, we're always here.
Absolutely.
Always here.
This is a pleasure talking to you. Anything else when we wrap up today?
No, it's been really good. Thank you very much. It's been really good. I look forward to the reels.
What you're going to see at this going forward now, your name and contact information will be at the top of the screen.
Brilliant. Okay, excellent. That's really good. It's good to know.
Okay, thank you so much, Victor.
Thank you so much, then. Thank you.
Thank you.
Bye-bye.